Hello, everyone. This is Marc Bautis from Bautis Financial. We just ended the third quarter, and as we approach the end of the year, I wanted to touch on several important topics, including the economy and market recovery updates, as well as forecasts from JP Morgan, Goldman Sachs, and more. Second, the Washington update and important tax law changes, which may have a significant impact on your financial plan. And third, end of year planning tips for income taxes, capital gains taxes, retirement, and estate planning. All right, so let's start off with the economic and market update. Here's a quick market review as of September 30th, showing year-to-date and one-year returns. One thing to note here is that the S&P is beating the NASDAQ on the year-to-date. And this is unusual from what we've seen over the past couple of years, where NASDAQ has been the leading index, definitely beating the S&P 500. Here on these three charts, we have a couple of additional indexes. So here, one thing to note is the small cap on the 1 year, where it's up 44.62%. Everyone loves their big, large, and mega cap stocks, but there is a place for small caps in your portfolio. And then also the other thing here is that emerging markets are flat year to date, and we've seen some volatility in them, especially recently. Okay, so if we look at these same indexes quarterly, returns were mostly lower in the third quarter, thanks to a rocky September. And then if you note here, you see the S&P was the only major US index to end the quarter in a positive territory. Here we can see third quarter returns for small caps, international, and emerging markets, which, as you can see from the negative percent returns, were not that good in the quarter. One of the big drivers in the economy has been the virus. This graph shows US progress towards achieving herd immunity from COVID. Each bar on the graph represents the combination of those who are immune through vaccination, prior infection, and those who have had both. On the y-axis, we can see the population is getting closer to that key 80% threshold that experts believe will result in the virus becoming something like the seasonal flu rather than a pandemic. Goldman Sachs believes that the recovery remains intact, supported by higher vaccinations and booster shots that may keep hospitalization rates manageable throughout the fall. However, the bar to global immunity is probably risen, requiring 80 to 90% of the population to have antibodies to meaningfully reduce the spread of the virus. According to JP Morgan, the Delta variant, it's not derailing global recovery, but progress does depend on vaccination rate and policy. China's 1/3 of global growth, and it is slowing, but it's still estimated to be growing at 6.5% year over year. And here, JP Morgan's also predicting that Europe will be a growth engine in the third quarter. In the graph on this chart, we can see the deep slowdown of China's retail sales, which were down about 25% in the beginning of the pandemic, followed by a sharp resurgence. And then now what we're seeing is another current slowdown. The current reading at the end of the graph shows China retail sales just 2.5% higher than the previous year. So the other thing to note here is that there's been a lot of talk about Evergrande, which is a real estate and property management company. They have about $20 billion in total offshore bonds outstanding, which is equal to about 9% of US dollar denominated Chinese bonds, which is according to UBS. So UBS believes that Evergrande will restructure its debt and limit contagion in the bond markets. So one of the thoughts are that if Evergrande defaults, it is just going to be an all-out. It'll be contagion and really impact fixed income all around the world. UBS doesn't see that happening. Goldman's neutral on gold, and they're neutral on oil and gas. However, they are not neutral on copper. So that's the highlighted region you'll see towards the bottom of this table. There's currently a supply squeeze coupled with increasing demand for copper for things like electric vehicles and green capital expenditure. Goldman projects that the 10-year US interest rate will slowly creep up to 2.3% in 2023. They also see the S&P 500 reaching 4,800 in 12 months with 6.2% upside. They see robust sales growth and record margin expansion, which led to strong second quarter earnings. With as we're seeing now into October, we're seeing the third quarter earnings reports by companies, and they seem to be strong as well. On the European markets, they're predicting a rise of about 10% over the next 12 months. Here in the graph to the right, we can see that JP Morgan's optimistic about earnings as well. Each bar on this graph represents the average earnings per share of the whole S&P. The y-axis shows us the dollar amount of the earnings per share estimated, and the y-axis shows us these bars over time. Companies can, the reason for the strong earnings, which they think are that companies are taking advantage of rock bottom interest rates, they're issuing large amounts of debt, they're using the proceeds to buy back stock, distribute dividends, do things that are usually looked favorably by investors. There's also, with interest rates so low, investors don't see any reason to invest in anything else besides equity. So we're seeing a record amount of inflows into equity ETFs and then outflows from bond ETFs. And then also what they do, they think that earnings will continue to be the driving factor in equity gains moving forward. So they're saying, which is not an uncommon theme, is that equities will outperform bonds in the foreseeable future. Okay, on the graph on this slide, we see the light blue line, which represents all items in the consumer price index. They all rose in 2021. But the forecasted CPI, which is represented by the dotted line, it's forecasted to actually drop over the next year. So inflation has definitely ramped up this year due to the economic rebound, recovery of prices for things that really got hit during when the pandemic first started, such as air travel, accommodations, tourism. And then we're seeing higher labor costs and rising prices for materials due to supply chain disruptions. After rising a lot, inflation has cooled this year. Inflation has cooled a little bit in August. The CPI, or Consumer Price Index, rose 0.3% for the month, and we're at 5.3% over the last 12 months, which is close to where it was projected at a 5.4% increase. The Fed is still coming out and saying that inflation is still temporary and that they have no need to rush to tighten their monetary policy. JP Morgan's outlook is showing that the labor force is growing very slowly. So on this chart, what we're looking for, this is data from the Job Openings and Labor Turnover Survey, and what this is showing as of July this year, the gray line has reached about 10.9 million current unfilled jobs, and you can see those on the y-axis. Employment's lower than what it was during the height of the pandemic. However, the economy has evolved, and one of the reasons for these large amount of jobs unfilled, it may be that there's a skills mismatch between jobs and workers. So it remains to be seen whether this will change now that some of the unemployment benefits have expired in September, or if it's going to stay consistent and we'll still see a pretty high unemployment rate. The American Association of Individual Investors, they track retail investor sentiment. And what they're saying is that currently the spread between bullish and bearish has gone down to negative 17% from positive 12% just a week earlier. And this is the lowest reading since October of last year of 2020. So what they're saying is that, basically retail investors are negative on the markets and on the economy. Okay, on this slide, we're going to look at some charts from Goldman Sachs, and these are what they think the risks are to the market in the future. They have an estimated timeline on when the Fed will announce tapering. They believe that a formal announcement will come in November of this year, followed by tapering at about $15 billion a month all the way into 2022, and eventually ending around July or August of next year. And then what they think may come after the tapering is rate hikes in early 2023. Obviously, there's a major risk of the market of COVID and the Delta, especially the Delta variant. I think infections are trending in the right direction right now, but we could see a new wave of infections before the end of the year. And, I don't know if that's going to have any impact or continue to impact the supply chains and the markets. Another significant risk is the Federal Reserve tightening monetary policy that we just talked about, but it may, if inflation does continue to rise, the Fed may tighten quicker than anticipated. There's also changes in tax law that are on the table right now. They may have a negative impact on corporate earnings, as well as bottom line for individual investors. And right now they're just proposals, and some are going through Washington right now. We'll talk a little bit about those later. So it still remains to be seen what's actually going to be in those final bills. So I think right now the markets are waiting to see what's going to happen. Fourth, slowing growth could be an issue, but we may finally, be seeing signs that inflation is transitory. So we did see that slow down in August, and we'll see how inflation does play out over the next couple of months. The last thing that's not on this list is that the valuations are high. The S&P is currently trading at 21 times forward earnings. So what happens now is that the company earnings, they have to accelerate significantly to grow into the price valuations that they have. And if we want the stocks to push up the prices going forward, the earnings have to grow into that as well. All right, so some major themes of the third quarter. September was the worst month for the markets this year, and in fact, all the way back to March of last year. The S&P 500 lost 4.8%, while the Dow Jones slid 4.3%, and NASDAQ lost 5.3%. S&P 500 did actually still manage to have a small gain for the quarter, making the third quarter the sixth quarter in a row that it was positive. I think kind of the reasons for that are what we've just talked about. Headwinds such as inflation caused by supply chain issues, the China Evergrande debacle, friction in Washington, they all kind of lended to it, although Congress did manage to pass a bill on September 30th to keep the government open until December 3rd. So that was positive. With yields still trading at historically low levels, a lot of people can see that few places outside the stock market can provide consistent, desirable gains. And even with the bad September, the S&P 500 is still up 15% year to date. The U.S. 10-year Treasury ended September at 1.528%. So, I think as inflation goes up, we'll also see that 10-year Treasury yield creep up as well. Goldman breaks down the largest risks that they see leading to a severe bear market. So that's one thing as an investor we probably want to avoid, is that bear market scenario. So and then also what they do is they think overall the risk is moderate. So they commented, obviously equity valuations are high, but there's no reason to suggest that they will not continue high, as in a low interest rate environment it is entirely possible that high valuations can stay there. Unemployment hasn't reached its lowest levels, and there are still jobs left to fill for the U.S. economy. So that's one of the risks to a bear market, is that it's at peak capacity and all the jobs are filled. So I don't think we're at that point right now. And while inflation has risen, Goldman believes that it is below target for a late cycle condition. So they're also believers, like the Fed, that the current inflation is transitory. JP Morgan, so if we transition a little bit into talking about asset allocation and different themes with that, JP Morgan sees a positive backdrop for international equities. They're currently seeing a 30% discount when you compare US to Europe and Japan for as the value to look at the price valuations for the different companies in the different regions. They also believe that value stocks should outperform growth stocks. So you do want to be selective about which type of stocks that you do own. And what their JP Morgan's advice is, focus on companies with true value and companies that will thrive, not just companies that have been beaten down and there is value there, but they've been beaten down for a reason, and that they're garbage companies. And then, like everyone else, they're thinking that bond yields will increase as well, which will decrease duration and credit risk. Will increase for emerging market bonds, high yield, and securitized debt. Okay, in this chart now, we're going to take a look at Goldman's views on asset classes. They see the more attractive asset classes being US and European equities, as well as the US dollar. What they consider less attractive asset classes include most countries' fixed income, as well as municipal bonds. And although municipal bond valuations are still elevated relative to historical levels, the technical imbalance from muni investors being flush with cash, while the issuers of muni bonds it remain limited. So, it's that simple supply and demand where there's a lot of people wanting to invest in muni bonds, not a lot of muni bonds. It's going to drive the price up. And if you do want to invest in a muni bond, it's going to cost you to do that. Here, what we're looking at is the chart display. It's the yield on the 10-year sovereign bonds. So yields here are displayed on the y-axis, and the values from this graph come from the Bloomberg Global G7 Total Return Index value, which it measures the yields on the 10-year bonds of the G7 countries, and that's China, France, Germany, Italy, Japan, the UK, United States, and the European Union. And we can see that in the current year, they're still at record lows. Goldman forecasts that these yields should get to 1% above by the end of the year, and that's illustrated by the green dot that you can see towards the end of the graph here. So what they're saying is to they're suggesting to take advantage of cyclical sectors and areas that perform better with increasing rates. So these are things like international equity, small cap stocks, and value stocks. And we'll talk a little bit about that in a second. Okay, this chart here shows the returns an investor would have experienced in the S&P 500 if they invested on the lowest price day of each year, the first day of the year, and the highest price day of the year. So the dark green line is the result of investing 500 on the best, which is the lowest price day of the year. That would leave you with a total account value over $500,000. The lighter green line shows someone investing $5,000 on January 1st each year without regard to price, resulting in a portfolio valuation near $450,000. And lastly, the lightest green line shows investing $5,000 on the worst, which is the highest price day of each year, resulting in a portfolio value of around $375,000. So all three of these options are really strong results, and it reminds investors to put cash to work no matter what the market environment. Timing the market, it's really hard, if not impossible to do. So it's not typically when, but whether you invest that counts. Okay, now let's talk about what's going on in Washington and some of the tax proposal changes that are out there. So no surprise, government spending is at record highs, tax rates are at record lows, and tax rates will have to increase to pay for the new budget bill. So I think it's really no secret that taxes will likely move higher, but they may not have the huge effect on the market returns that some people are thinking, but they may influence individual investors' net returns. So let's talk a little bit about this. The tax proposal approved by the House Democrats on September 15th, it'll roughly raise $2.9 trillion over the next 10 years, and it's primarily focusing on businesses and the wealthy. So the top corporate tax rate would increase from 21% to 26.5%, and that top rate would apply to any corporation making more than $5 million a year. Corporations making less than $400,000 a year would see their income tax rate actually drop to 18%, while those in between $400,000 and $5 million would see no change. The 20% qualified business income deduction, or QBI deduction, for pass-through entities, it would be limited to $500,000 for a joint return, $400,000 for an individual return, $225,000 for married filing separately, and $10,000 for a trust or estate. So these corporate tax changes they're projecting could raise $540 billion. The House Ways and Means Committee approved legislation that comprises its portion of the $3.5 trillion Build Back Better Act that contains Biden's administration priorities for social and climate programs. So this is the 881-page bill that if you wanted to read that, you're more than welcome to do so. It features a slew of provisions, including the paid family and medical leave, mandatory auto IRA programs, as well as approximately $2.3 trillion in tax increases on high-income Americans to help finance this bill. So in here, they've approved the increased marginal tax rate to 39.6% for the highest earners, as well as an increase to the top capital gains rate to 25%, which is really 28.8% for most people that are in that 3.8% Medicare surtax. They're also cutting out backdoor Roth IRA strategies for 2022 and Roth conversions in 2031. Goldmans, what they're suggesting here is that higher tax rates may not sustainably alter market returns, but they may have an effect on investors' bottom lines and create more focus on asset allocation, tax loss harvesting strategies, Also, tax hikes do crimp earnings, although some of the studies that have come out have demonstrated that modest tax hikes can be sustainable. All right, so let's look at some of these tax changes or tax proposals in a little more detail. All right, so the House Ways and Means Committee proposed these changes as part of their to pay for their 10-year $3.5 trillion budget bill. So they have the capital gains tax going from 20 to 25%, which actually isn't as high as the Biden administration's initial proposal of 39.6%. So they were actually, the Biden's proposal initially came out and wanted to make the top capital gains the same as ordinary income. So right now we're going from 20 to 25% rather than 39.6%. The top marginal tax rate would increase from 37% to 39.6% for anyone making over $400,000 or more, or married couples making $450,000 or more. In addition, they proposed a 3% surtax on individuals and married couples making over $5 million, but no changes to the taxation of assets at death, which was again something that was also initially sought out by the Biden administration. So the 3% surcharge on these, someone making over 5 million, it'll also apply to trusts with income over 100,000. In the next slide, we'll touch on some of the new proposals for Roth IRAs and required minimum distributions. Okay, the strategy of making non-deductible IRA contributions and then converting them to Roth IRAs, commonly called the backdoor Roth IRA, it looks like it's on its way out starting in 2022 for all income levels. The same goes for the mega backdoor Roth strategy inside of a 401k plan. And that's, you can't convert those to after-tax dollars after 2021. So instead of, a lot of these were set to sunset in 2025. Once we start talking about estate planning, there's an $11.7 million exemption, which as part of the new plan, instead of sunsetting in 2025, it will be cut next year to $5 million and adjusted for inflation going forward. The net investment income tax distribution from S Corps, it will apply to earners who make over $400,000 or $500,000 if you're married filing jointly. And then those over the $400,000 or $450,000 threshold may not be able to do any Roth conversions in 2031. And then also what's added in there is that commodities, currencies, and digital assets are subject to wash sale rules, which is covers whether you can deduct a loss on selling an asset, and if you do buy it back within 30 days, that loss isn't allowed under the wash sale rules. Okay, as we discussed, the new corporate tax rate is going to be raised from 21% to 26.5%, which is still less than Biden's original proposal of 28%. All right, the chart here, it shows the impact of the new tax reform could have on the earnings per share of different sectors, such as communication services, technology, and healthcare. These industries could see a significant reduction in their earnings per share. And looking at the top three sectors here, communication services, tech, and healthcare, we can see that the combination of statutory tax increases, which is in the navy color, and the potential GILTI increases in light blue, when you add these two together, it means that the three sectors could see earnings per share deductions of nearly 10%, that's what's displayed on the x-axis. Other sectors in this chart, they're mainly affected by the statutory corporate tax increase, but won't be as heavily affected as those hit by both taxes. And then corporations in the tech and communication sector will face higher taxes for income owned overseas. The GILTI tax, it discourages corporations from moving intangible assets like an intellectual property and other related profits to countries with lower corporate tax rates. So that's that, shifting of your headquarters, your domicile of your headquarters to a lower tax country. This tax is meant to dissuade or discourage companies from doing that. Democrats will slash the lifetime exemption next year. So instead of 2025, it going to 5.5 million for a single and 11 million for married. This has really a lot of implications for, if you're wealthy, there's been a lot of different strategies involved to avoid taxes. One of them called the intentionally defective Grantor Trust. And these have been used to transfer wealth-free of estate taxes. If you're over that exemption, 11.5 or 22 million, the new plan destroys the strategy. So the plan would pull the grantor's trust back into the person's taxable estate when they are deemed the owner of the trust. So the committee would also tax a sale from a grantor trust to its owner. The proposal would also restrict the use of discounts, which reduce the value of families' estate assets. Currently, the wealthy can place certain assets like stock into an LLC or another entity and divide it amongst heirs or trusts. Since no one has full control over the asset, the wealthy are currently allowed to reduce the asset's value for a tax break. It's not all bad news for estate planners, though. The new rules would apply only to future trusts or transfers after the change is enacted. Okay, so some of the things that the new proposal did not change. Eliminating the step up in basis was a bit of a stretch because it would have actually, the tax bill is trying to target people earning over $400,000. One of the things that was proposed is that it eliminates the step up in basis, and that would have affected pretty much everyone. So that did get pulled out of the bill. Lawmakers from New York and New Jersey, they see the SALT, which is state and local tax deduction, as a priority for middle-class families. So there weren't any mention of any changes in the new House proposal. It's still in limbo, but at one point it does have to get addressed. Partners in hedge funds and private equity benefit from the long-term capital gains treatment on their income, but now they need to hold the asset for more than 5 years instead of 3 to get that favorable capital gains treatment instead of ordinary income. So that's what's commonly referred to as carried interest. So that does survive. Existing trusts and other techniques used to pass assets to the heirs will largely be unaffected. And it's important to remember nothing's settled yet, and it's not clear whether a tax proposal from the Senate's Finance Committee will include the same policies or same changes that the House Ways and Means Committee has in there. So we could see a lot of changes come in the near future. All right, so now the question that begs to be answered is, what do we do? So there's several solutions to utilize when taxes increase. And there's different proactive decisions that can be made, such as using tax efficient vehicles like muni bonds, exchange traded funds, insurance, even insurance products. You just have to look at the pros and cons of everything. You could utilize tax loss harvesting, and managing different tax lots for investments purchased over different periods. So you want to be kind of strategic about when you do sell something and whether you're harvesting a loss or actually creating a gain, dependent upon where your income is and what you'll be taxed on that gain or what you can deduct on that loss. You really want to look strategically on it. Allocating assets between qualified retirement accounts, trusts, estate planning strategies, and then tax favorable insurance products are definitely some things to consider as well. Another thing is you may want to consider accelerating some of your gains now in 2021 before the tax increases. Although one thing that was really strange that was in the bill is that capital gains taxes are retroactive to when the bill was published, so back into September 15th. So if you sold something prior to September 15th, you'd be subject to the old capital gains taxes. If you sold something after September 15th, even before the bill was passed, you'll still be subject to the new capital gains tax rates. All right, so some of the key questions you should be asking now are, could you be subject to that higher tax bracket of 39.6%? Also, the marriage penalty is back, especially if your income is over 5 million. You also have to consider that 3% surcharge. You want to think about will you be subject to the higher capital gains rate of 25%? You could still, there's not really a choice you have. It's pretty straightforward that, unless it does change in the final bill, that you would have had to sell something before you even knew that the bill came out and the proposal came out, and that you would be subject to higher tax rate. And then just some of the, there's still some of the estate planning, the Roth conversions that you just have to make that decision of, all right, do I want to implement this On some of the conversions, you may have until 2031. If you do want to implement a backdoor Roth, you may only have until the end of this year to actually do it. All right, a couple more things that you want to look at in terms of end of year planning. So again, top rate raising up to 39.6%. So you want to really try and maximize your tax deferral opportunities. You want to look at qualified accounts, other tax efficient strategies. If there's an option to accelerate your bonus and any income acceleration into 2021, if you're at a lower rate in 2021 versus 2022, you do want to use itemized deduction timing. And one strategy that is worth considering is bunching your deductions, like medical expenses, property taxes, charitable contributions. And if it does work, you want to look at taking the standard deduction 1 year and then bunching the previous 2 years of some of these expenses and deductions into the following year, where you can take a bigger, itemize and take a bigger deduction than just taking the standard deduction. Okay, and as far as the the capital gains tax that's about to increase, or that should be increasing, a couple things you might want to look at: alternative strategies like installment sales, so that if you are selling an asset that is going to generate a big capital gain, bump you up into higher tax brackets, you want to look and see if you can spread that income out over, potentially deferring that over into future years. It may not make sense, but it's at least something to consider. The other thing is you want to look at forcing your tax loss harvesting, and you have to look at it from the perspective of preserving the value of your portfolio while defraying the cost of capital gains. So there's always a balancing act. And I think one thing that people do forget a lot is they'll look on paper and they'll see either an unrealized gain or an unrealized loss. You don't actually, that's just on paper. It's not until you actually sell it. But selling it results in, one, you've sold it, you no longer own the asset, but it could also result in a tax consequence to do. And you have to remember that you can use a capital loss to offset your ordinary income up to $3,000 per year. We've implemented a strategy called direct indexing, which helps a lot in tax loss harvesting. And it's not just a $3,000 a year, but we're seeing people being able to use it to offset some of their other capital gains. They may have employer stock and they have big capital gains built up, and using this direct indexing strategy, they can defray some of the capital gains tax that they would have owed, if they didn't utilize that. So you definitely want to consider using your gift tax exemption while you still can. The 11.7 million lifetime exemption will be cut to 5 million. So, obviously you want to consider making annual exclusion gifts, medical gifts, tuition gifts, if it makes sense to get assets out of your estate. You want to be proactive about how you gift so that you avoid having to rush things and potentially make mistakes. So there's some different types of trusts that you can utilize, or that you should at least consider. So there's GRATs, SLATs, QPRTs, loan forgiveness, and other types of trusts that you can use. And then one thing to remember on gifting is, that exemption is going to be pretty much the exemption that it's going to be. It may adjust for inflation, but the assets may increase over time. So if you gift $10,000 today, that asset will grow out of your estate. If you didn't gift that $10,000, it may be, sometime down the road, 100,000, and then now you're having to gift a lot more, and you may not have that exemption to gift. So one good thing about gifting is that it gets the asset out, and any future growth is out of your estate as well. It kind of goes contrary to what the thought has always been, but you may want to consider paying taxes on IRA balances while your taxable income is low. So you just want to look and, again, it's playing the tax brackets that you have, as well as looking at the income coming in. And if you did take a distribution from your IRA, what tax would you owe on it? And you kind of just have to project in the future, look at things in the future. Maybe you'll be retired in the future. A lot of people think that their income is going to be lower, but because of Social Security, pension, other types of income that they have coming in, oftentimes it's not. And so, you may want to look at taking some of that IRA balance down now. You also want to look at Roth conversion strategies. So the really benefit of that is it gets money into the Roth, and then it doesn't, you don't, if tax rates go up even more in the future, you don't have to worry about it with a Roth. Okay, a couple other things related to the Secure Act. You may want to consider naming a non-spouse as a beneficiary. Just because the Secure Act changed a lot how required minimum distributions work for non-spouse beneficiaries. It used to be that you'd be able to utilize a strategy called the stretch IRA, where the beneficiary will be able to spread their IRA out over their lifetime. But because the government is looking for money, they're forcing people to withdraw all of their inherited IRA over a 10-year period of time. So, the stretch IRA did change. So it's really the tax planning with regards to IRAs and beneficiaries. It's of utmost importance right now. All right, so we covered a lot today. So just a quick review on some of the key takeaways. The global economic recovery remains intact. Corporate earnings are still driving the markets higher. Yes, equity valuations are high, bond yields are definitely low. So you just have to be selective in your portfolio moving forward. We talked about taxes, how they're probably going up for someone in that $400,000 individual, $450,000 married filing jointly income group. And then investors who are targets of these proposed tax legislation, you really should look at things that can be done now. So, one of the things making income tax diversification a priority, and you just want to, it'll help have more control and flexibility in retirement. So thank you everyone for listening in. As the disclosure, don't make any financial decisions without first consulting with a financial professional. But if anyone does have any questions on this, anything we covered today, anything really financial related, you can go to my website, bautisfinancial.com/call, and you can set up a free consultation.